The Fibonacci retracement tool is being underrated by traders, but believe me when I say it is one of the most powerful tools you will need as a trader. Now, if you are someone that don't know how to use the Fibonacci retracement tool the right way, or you have seen traders making use of this particular tool, but you don't know how this particular tool works, in this particular video, I am going to show you what the Fibonacci retracement tool is, when to use the Fibonacci tool, and how to use this particular tool. Now, if this is your first time coming across my video, you will want to go ahead and hit the subscribe button. Also turn on post notification, hit the thumbs up so that YouTube will recommend this video to more people that will find this particular video interesting. Remember, you are not being charged to subscribe. Time, let us dive in. Today, we'll be looking at Fibonacci retracement tool, how to use the Fibonacci retracement tool the right way. Now, I don't want to bore you with how the Fibonacci retracement came to existence, who is the founder and stuff like that. All we want is to know the proper way to use Fibonacci as traders. Now, it says here, Fibonacci trading is a technical analysis method used by traders to identify potential support, resistance, and reversal levels in the market, with key point on support, resistance, and reversal levels in the market. Now, how does this Fibonacci works in trading? Traders use a tool called Fibonacci retracement to measure how far price might pull back before continuing its trend. Many of us don't know when to use this particular tool. Now, the Fibonacci retracement tool is best used when the market is trending. It's either the market is in an uptrend or the market is in a downtrend. You will not want to be using this tool when the market is consolidating. Why? Because it tells us when the market wants to retrace to, where it will retrace to before continuing its trend. And you only want to be using this particular tool when the market is trending. It's either the market is in an uptrend or the market is in a downtrend. Avoid using this particular tool when the market is consolidating. How to draw your Fibonacci? In an uptrend, price moves from point A, which is the low, to point B, which is the high. Now, you can see right here, this is an uptrend, and we all know the characteristics of an uptrend. Price giving us higher highs and higher lows. This is a higher low, right? In an uptrend, when drawing your Fibonacci, you want to draw it from the low, the recent low, to the recent high, and wait for price to pull back. Okay, it is from that pullback that you should be expecting to enter the market and continue pushing price upward. Remember, in our definition, we say it is used to mark support and resistance, and in an uptrend, this is a support, right? Now, price will pull back into the 38.2%, 50, 61, and 78.6%. Now, in this particular video, I'm also going to tell you the particular sequence that I prefer using when it comes to the Fibonacci retracement tool, and it is no other sequence than the 78.6. I will always want my price to pull back into 78.6 before I will start looking for entry opportunities. I'll only want price to pull into the 78.6% for me to start looking for trading opportunities. Now, on a downtrend, the reverse is the case. You wait for price to move from point A, which is the high, to point B, which is the low. In a downtrend, you are looking for the recent high and you drag your Fibonacci all the way to the recent low, waiting for a pullback before looking for entry opportunities. And the same thing that applies on an uptrend should also apply on a downtrend. Wait for price to pull back into the 78.6% retracement zone before you should start looking for trading opportunities. Now, a lot of traders will be like, what time frame is best for if I want to use this particular tool? Now, there is no perfect time frame to use the Fibonacci retracement tool. It works on all time frame depending on the type of trader you are, but it is best used on your entry time frame of preference, right? Be it swing trading, day trading, or scalping, it works on any time frame, be it the daily time frame, the 15-minute, the 5-minute, the 4-hour, the 1-hour, any time frame, but it is best used on your entry time frame. that particular time frame you use to enter and exit the market, that is where I prefer using my own Fibonacci because it gives me an extra confirmation to enter the market, right? Now, pro tip, Fibonacci doesn't predict the market. For those of you that will say, I watched a video that said whenever Fibonacci pulls into the 78% retracement zone, I should be looking for an opportunity to buy if the trend is in an uptrend or sell if it is in a downtrend. Now, remember that Fibonacci doesn't predict the market, but rather it gives you higher probability zones, not guaranteed outcome. So your edge comes from what? Risk management, patience, and confirmation. This particular tool should not be a standalone tool. You should not only use Fibonacci. You need other confluences in order to dictate if price is actually bullish or the market is bearish. Now, without wasting much time, I will take you over to my chart to show you how this particular Fibonacci works and how I use this particular Fibonacci to enter the market and make some money for myself. So let's go. This video. Now, before we continue, after watching this video, if you also like to make use of the Fibonacci as one of your confirmation before taking any trade, look at the way I was able to set my own Fibonacci zones. Pause this video. You can copy my settings and also replicate it on your own chart. Without wasting much time, let's continue, okay? Before using the Fibonacci chart, now, before using the Fibonacci, just as I mentioned, I said the Fibonacci tool works best in a trending market. It's either the market is trending to the upside or it is trending to the downside. If the market is consolidating, there is no need making use of the Fibonacci tool, right? And you can make use of it on any time frame. In this particular example, we are going to make use of Fibonacci using the 1 hour time frame. Mere looking at this chart, you will see that this market is bullish. You can see that price is giving us high, low, higher low, higher low, and you can see how this particular market is moving. Let's take, for instance, I come into this market right here and I want to take this particular trade. Immediately the market broke this particular high. I wanted to enter from the pullback. Using my Fibonacci, all I have to do is, remember, in an uptrend, you want to draw from the recent swing low to the recent swing high. Wait for price to come into the 0.78 or the 78% retracement zone. At this particular zone is where I want to look for entry opportunities, this particular zone here. If price should react off this green zone, this 61% retracement zone, I'm not interested. I only want to take this particular trade if price should react inside of this particular zone. Then that is when I'll start looking for entry opportunities, either to the upside if the market is bullish or to the downside if the market is bearish, right? Now you can see that immediately price retraced into this zone, price started pushing up, giving us a new break of structure, right? Now, let me delete this and let us see more examples. Let's say, right, you were not able to catch this particular move, but you wanted to catch this move and this particular trade. I took this particular trade and this trade hit my profit target, I think last night or this morning. So let's say you were not able to take the first trade I show you. All you have to do is to come here, the recent swing low, you drag it all the way to the recent swing high, and you can see that price came back into the 0.778, sorry, into the 0.78, that is the 78% retracement zone, even though price dropped past it slightly. But remember, our target is waiting for price to come back into this yellow zone before we will start looking for entries. If anything should happen and price reacts off this green bar, I am not interested in this market. Bar. You can see price pull back into this bar. When I entered this trade, I had two take profit. One of my take profit was at the top of this zone right here, and my overall take profit was at this high, the point of reversal, right? And as you can see, price went smoothly, took out my first take profit, getting very shy of my second take profit. It pulled back and I was not panicked. Now the question is, why was I not panicked? Because I knew that we are on an uptrend. we are on an uptrend. I can only panic if price should take out this particular low right here. That is when I'll be panicking. All I had to do was to take out my Fibonacci, draw from this low to this high at the point of reversal, and as you can see, price pulled back into our 78% retracement, and I entered more positions. I entered more positions after I got a confirmation of this zone. In zone taking, all I had to do was move my stop loss past break even, wait for price to come and hit my second TP. But before that, price retraced, and you can see it pulled back into our 78% retracement. Then you can see price went all the way to our my full take profit. That is how this Fibonacci works. Now, this is an example on an uptrend. Let us look for an example on a bearish market, that is price giving us lower highs and lower lows. Now, as you can see, this is a downtrend. You can see price giving us a high, a lower low, a lower high, lower low, lower high. This is a characteristic of a downtrend. Now, let's take for instance, you are about to enter this particular market. You were not able to get an opportunity at this particular zone. Let's say you drew your Fibonacci from now. Remember, on a downtrend, you want to draw from to a swing low, right? On an uptrend, you are drawing it from a to a swing high. On a downtrend, you are drawing it from a swing high to a swing low. And you can see price did not pull back into this our yellow bar right here. You have no business taking this trade. All you have to do is to fold your hands and stay away from the market. The price did not react to your entry zone. That is how you can become profitable in the long run. You must not jump into every trade. Now, after price did not react, let's say price gave us this break of structure down here. After this break of structure, you were able to draw your Fibonacci like so. And you can see that price has nicely entered into the 78% retracement zone, our yellow bar. This is where I want to be looking for trading opportunities. And as you can see, immediately we had this break of structure right here. Price pull back into this yellow bar. I will start looking for entries to enter this market and sell all the way to the downside. Now, after this particular pullback occur, we had this new pullback. And as you can see, price did not pull back into our yellow bar. I have no business taking this particular trade. Okay, this particular trade is void. But after this pullback happened, price pulled back into this zone. Now look at how I draw my Fibonacci. You can see swing high to swing low, swing high to swing. That is the recent swing high from the pullback to the point of reversal. And as you can see, you see price. I was in this particular trade. I took this particular trade and I held this trade all the way to the point of reversal. Immediately I entered this trade. You see how price pull back into our yellow bar. Immediately I entered this trade, price dropped all the way down here. That is all you have to know about the Fibonacci. Remember, it is a very powerful tool depending on how you use it. By the time you watch this video, you should be able to make use of this particular tool very well. In our next video, I am going to show you how to make use of the discount and premium zone. So if you are yet to subscribe to this particular channel, please ensure you do so.